Whether you're thinking about your home loan interest rate or just using a payment app on your phone, there's one institution quietly pulling all the strings: the Reserve Bank of India. So over the next few minutes, we're going to break down the RBI's Constant Balancing Act and what it actually means for the money in your pocket. Let's dive in. So how are we going to tackle this? Well, we'll look at it in 4 key parts. First, we'll start with the big picture: how the RBI steers the entire economy. Then we're going to zoom right in on how it's rewriting the rulebook for our digital future. After that, we'll see how it protects your wallet and your everyday banking life. And finally, we'll look at the consequences: what happens when those rules get broken. All right, first up, let's talk about the RBI's most visible job: acting as the pilot for the Indian economy. You really have to think of it as them keeping a steady hand on the wheel, navigating all of us through some pretty choppy financial waters. And the biggest tool they have for that job, it's the policy repo rate. Now, what is that exactly? Well, in simple terms, it's the rate at which the RBI lends money to other banks. And that rate, well, it trickles down and influences the interest rates on your loans. For now, the RBI's decided to hold this rate steady at 5.5%. After a bunch of cuts to get the economy going, this pause really signals that they're now focused on stability. So you might be asking, why hit the pause button? Well, it really all comes down to confidence. The RBI is forecasting a pretty solid 6.5% GDP growth. They're seeing strong demand from people like you and me, plus a boost from government spending. So in their eyes, the economy's got enough juice right now. There's no need to hit the accelerator. It's better to just keep a steady course. But, steering the economy isn't just about today's interest rates. It's also about getting ready for tomorrow. And that brings us to the RBI's second huge role: completely rewriting the rulebook for a future that's going to be dominated by game-changing tech like artificial intelligence. To help guide banks into this new territory, the RBI laid out what it calls the 7 sutras for AI adoption. Now, what's really interesting here is that these aren't super rigid technical rules. They're more like foundational principles. It's like instead of giving banks a detailed map, the RBI is handing them a compass to innovate responsibly. It's a smart way to encourage new ideas while making sure that trust and fairness stay at the absolute center of our financial system. But it's not all about high-level philosophical guidance. The RBI is also getting very specific where it really matters. And a perfect example of this is the world of digital lending apps, which has just exploded. With that fast growth comes risk, so the RBI is stepping in with some very concrete new rules to protect all of us. Now, to really get these new rules, we need to know who we're talking about. And a key player here is the Lending Service Provider, or LSP. So what is that? Honestly, it's basically the company behind the loan app you're using. They aren't the bank itself, but they act as the bank's agent, doing everything from getting you signed up to sometimes even handling loan recovery. So what do these new rules actually mean for you, the person borrowing the money? Well, they bring in some absolutely crucial protections. First, transparency. Lenders now have to give you a key fact statement that spells out every single cost. No more hidden fees. Second, security. The loan has to go straight into your bank account, not through some murky third party. Third, you get a cooling-off period, a chance to back out of the loan without a penalty. And finally, and this is a big one, every single digital loan now gets reported to credit bureaus. That's huge for building a formal credit history. Okay, so we've talked big picture policy, but let's see how the RBI's influence actually makes our day-to-day banking life just a little bit easier and, frankly, less of a headache. Oh man, we've all been there, right? You get that dreaded email or message asking you to re-KYC. The old way was such a pain. You had to dig up all your documents, maybe even take time off work to go to a bank branch. Well, the RBI has simplified this massively. Now, if your address hasn't changed, a simple self-declaration is all you need. It sounds like a small change, but it removes a huge, annoying task for millions of us. The RBI is also stepping in to fix a much more sensitive and, let's be honest, an incredibly difficult process. What happens when a family has to settle the bank accounts of a loved one who's passed away? And to fix this, the RBI is proposing a really clear and firm deadline. Once a family turns in all the right paperwork, banks would have just 15 days to settle any claims on deposit accounts and lockers. This isn't just about being efficient. It's about bringing some much-needed certainty and, frankly, compassion to what is an incredibly painful time for any family. And to make sure banks actually take this deadline seriously, the RBI is putting some real teeth into the rule. For every single day a bank is late in settling a locker claim beyond that 15-day limit, they could be fined 5,000 rupees. That sends a pretty powerful message that the consumer's experience is a top priority. Which brings us perfectly to our last section, the RBI as a tough enforcer. Because look, having rules is one thing, but making sure they're actually followed, that's a whole other ballgame. This is where the watchdog really shows its bite. And believe me, that bite can be expensive. Just take a look at some of these recent examples. You've got major banks being fined pretty hefty amounts for all sorts of things, from cybersecurity and KYC failures to just basic problems with customer service. These penalties are designed to send a crystal clear message to the entire industry. Following the rules is not optional. But it's really important to understand why these fines are happening. The RBI isn't just reacting to one bad customer experience. This is about protecting the health of the entire financial system. By enforcing these rules so strictly, they're making sure it's a level playing field for all the banks, and more importantly, they're protecting the long-term stability of the economy that we all rely on. So when you take a step back, you really start to see the whole picture. From the massive, macro-level decisions like interest rates, all the way down to the tiny fine print on a lending app. The RBI is performing this constant, delicate balancing act. It's a nonstop juggle between ensuring stability for the economy, encouraging innovation for the future, and, most critically, protecting you, the individual consumer. And that really just leaves us with one final question to think about. As our financial world gets faster, more digital, and more connected than ever before, the challenges are only going to get more complex. So, what do you think is the next great test for the RBI in this ongoing balancing act?